All right, guys. Thank you so much for taking a little bit of time out of your Saturday. I know we all have busy schedules, busy lives. I'm just going to get right into it. I know I've got about 45 minutes to talk to you guys about candlesticks and the way I use them. I think you can find this super exciting. Um, I was introduced, my name is Serge Berger, and I'm the founder of thesteadytrader.com. I think you made an excellent choice to attend this series of webinars today. It's a lot of really great stuff here, guys. Fully agree with what Todd said and the previous speakers. What I do is I help traders and active investors reach a level of consistent profitability that they never thought possible. Did you know that the reason why most traders are not making money is because they actually just simply overcomplicate things? That's right. Most traders make things much too complicated, and that's not really something that a lot of people understand until much later in their career path. So I'm trying to get you guys to understand this as quickly as possible. It's taken me many years to understand that. So today I'm going to show you guys a highly profitable three-prong trading approach that has not only made me a ton of money over the years, but has already allowed hundreds of traders just like you to live a life of financial freedom by reaching consistent profitability. How would you like to be able to get up in the morning and not care which direction the market is heading because you know you have a simple, trustworthy, and most importantly, a repeatable process that consistently keeps you on the right side of the market? Furthermore, how would you like to be able to do this from, let's say, your beachside hotel room in Hawaii or your slopeside hotel room in the Alps? Well, that might sound a little bit silly, but it's actually a very realistic lifestyle to have if you learn to follow this straightforward three-pronged trading approach that I will show you today. Financial freedom is something that many traders aspire to, and my three-pronged trading approach has allowed me to live a wonderful lifestyle where I spend a lot of time traveling. I spend part of the year here in Florida and the other part of the year in Switzerland and other parts of Europe. So it's a very realistic lifestyle to have. I'm not, I'm living that life, so I can fully attest to that. So, but the key is to have a repeatable process that's very straightforward. So success as a trader really isn't that difficult. So with the approach that I'm going to show you guys today, I know that everyone can do this. So without further ado, let's get started here. A couple of words about myself. I have been fortunate enough to work both on the buy side and on the sell side of Wall Street throughout my career, and that has allowed me to not only see different asset classes from fixed income and various derivative markets to equities and so on and so forth, but also it's allowed me to really work with some of the very best traders and investors out there. And yeah, I'm now very fortunate to be able to pass this knowledge directly on to my subscribers and other clients that I have, and of course the broader audience such as yourself. So that's just a little bit of about myself, so you have a little bit of context. So you know what sort of where I came from, and so we can kind of contextualize this all this information. All right, let's move on. So like I said before in the introduction, I'm a big fan of just keeping it simple, and I can tell you after nearly 20 years of doing this that trading and investing really doesn't have to be complicated. In fact, the more complicated you make it, the more you put barriers in your way. The key is to have something that's very repeatable. So the reason or the way people make things too complicated is by looking at too many conflicting data points, and what we need to be able to do is eliminate the noise. And these days, with apps and things pinging up on our phones and our desktops all the time from Twitter messages and whatever else we have going on around us, it's actually getting increasingly difficult for people to be able to focus on what matters. But that's exactly the key. We need to be able to eliminate the noise, and the only way you can do that is by having a straightforward and repeatable process. And the reality is that the more straightforward your process is, the easier it's going to be for you to be able to stick with it. Think about that, right? So the very best professional traders that I know have a very simple but a repeatable process. So like, for example, traders at investment banks like market makers only actually focus on a couple of stocks. And some of the very best traders that I know only focus on one or maybe two, maximum three types of strategies. Very, very simple and straightforward. But they get amazingly good at those strategies, or maybe those few stocks they focus on, right, if they're market makers. But for the most of us, that means focusing on just one or two types of setups. Now, if the very best traders in the world only focus on like one or two types of setups, why is it that the typical private investor at home tries to become a jack of all trades when the pros don't even do that, right? It doesn't make any sense. So the key to success in this business, in my honest opinion, is that you have to be able to focus on one or two types of setups and then look for that across the universe of stocks, indices, and other types of asset classes. I think that's really, really, really a big part of being successful in this business, as opposed to looking at looking at every type of possible trade and only focusing on a few stocks or indices or currency pairs or something like that. So okay, that's a little bit of an introduction, and let's move forward. Like I said before, institutional traders have a simple, repeatable process, and what I'm going to show you guys today is my highly effective, repeatable three-prong trading process. I know everyone can do this straightforward approach, and I'm going to make a big claim here, but I've seen so many people come through this that I feel comfortable saying this. I think it's literally going to change the way that you look at the financial markets once we are through this presentation today. Okay, so let's do a real quick exercise before we look into this. And I like to do this just for one, I like to get a little bit of engagement. I think it's always good for people to get a little bit of perspective of where they are, to be honest with themselves. So ask yourself, if you are, there's sort of three stages I think people fit in. If you are a beginner and you're just reading and studying, and you've never actually pulled the trigger, you're probably in stage number 1, and you can answer this out loud if you will, or if you'd like to, or just look at it as a rhetorical question. If you have done this for a couple of years, but you're still not really sure what you're doing, you're going through the initial emotions of fear and greed, you're probably in stage number 2. And if you've done this for more than a few years, but you're still losing money, or you're not making as much money as you'd like, which is kind of almost the same thing, then you're probably in this stage 3. So either way, it's important to just kind of be honest with ourselves where we are, because if you're in stage 1, but you really think you're in stage 3, and vice versa, that's just not really a great thing to do. So anyway, let's move on here quickly on the agenda today. What I'm going to show you guys is why identifying investor mood or emotions is critical to success as a trader and investor. I'm going to show you guys how to consistently find the highest probability points to buy any given stock, index, commodity, or currency for that matter. And then I'm going to tie all this together by giving you the blueprint to this amazing three-pronged trading and active investing approach. And then finally, as a bonus, I will reveal my absolute favorite option strategy that you guys can implement right away to generate monthly income. So I hope you guys are excited. Let's do this. So for a little bit of perspective, and I don't know how many of you guys are familiar with candlesticks, how many of you guys may be using them, but I really think, again, after many years of doing this, I think people make this whole business of candlesticks much too complicated. I think there are too many candlesticks out there to learn them all. I think you really have to just focus on the ones that work, which tend to be, the ones that actually repeat often enough for you to be able to get your head around them. So use the ones that are the most profitable ones. Only a few candlesticks are actually worth focusing on because all the rest don't show up enough, and they're too sort of they're too esoteric to learn. So there's only actually a few that are worth learning, and let's go through this, and let me just kind of take you through step by step. Well, just quickly around the basics around candlesticks, and I should say that candlesticks can come in any time frame. You can look at 5-minute time frames, daily time frames, weeklies, whatever you want. Let's just take the daily time frame for today's presentation purposes, and we can essentially have 2 types of days, in that sense, if you will. We can either have what is a down day. You can see the day here for this, let's say, stock opened here. The stock closed lower, i.e. down here, but the intraday range actually extended well above and beyond that intraday, that open to close range. Alternatively, we can see what's called an up day, right? Stock opens here, at the end of the day closes up here, but once again, the stock extended well beyond the open to close range. Well, the most important part about this whole situation with candlesticks is what is the relationship of the daily high, low, open to close? And I think the daily close ultimately is what makes the real big difference in being able to tell us a lot of the important information that we need to know. So that's just a little bit about the basics on that. Let's move on. The thing about candlesticks, guys, is that they're very visual. And I have personally conducted studies on this. This statistics here is sort of an official, more academic study done by other people. But the reality is it's probably somewhere between 60 and maybe 80% of us that have a much easier time to understand or learn something by looking at a series of pictures. So I don't know if you've ever put together like an IKEA furniture or something like that, where they give you like a bunch of visual, easy, step-by-step pictures of how you have to put that thing together, as opposed to just giving you a bunch of words. Most people, again, 60 to 80% at least, in my opinion, is where where that is helpful. So people have an easy time seeing things through a series of pictures. And what that translates to when it comes to the stock market or any financial market, for liquid financial market that matter, is that it allows us to be able to determine much better where we need to get in and get out, and actually ultimately it's much easier for us to be able to stick to our own rules, which is really anything, and that's really the bottom line. That's really the huge key to me when it comes to this investing business. So investing and trading. So continuing with this, so the bottom line is that candlesticks are much more visual than your typical bar or line chart. So the clear visual representation of price action is the obvious thing that's being represented to us on the chart. But really, if there's nothing else you take away from this presentation, guys, know this. Candlesticks, the way I look at them, and not many people do this, they really display to us, yes, they display price action, but more importantly to me, they display investor sentiment and investor emotions through the lens of price action, or you could also call it footprints, investor footprints. So candlesticks, to me, represent investor sentiment and investor emotions through the lens of price action. If you can learn to consistently think of price action that way, you will become much more consistently profitable in almost no time, as soon as you understand that. It's a question of how much you want to be profitable in order to be able to understand that you need to look at the market through the lens of investor psychology. Okay, we're still looking at charts, but we're looking at them differently. It's going to allow you to be able to stick to your stops and price targets much better. Okay, so let's continue along this with this and go to the next slide here. I think that beyond the fact that candlesticks just work, it's just a fact that they work very well, the formations are much easier to spot than many other types of things out there once your eyes are a little bit trained, and that's actually very simple to do. So it's all about decision making without emotions. And when we really talk about without emotions, we talk about that the way candlesticks allow us to trade is that they give us defined risk and clear stops before we get into the trade. And they're very visually clear where we need to get out. And think back to that slide I showed you guys before about the visual learning, that people have an easy time learning something through a series of pictures. Well, if candlesticks can give you that benefit to really tell you where you'll be proven wrong, that you actually literally know where investors' psychology has changed, you'll have a much easier time sticking to your profit targets and your stop losses if you know what happened through the lens of investor psychology. We'll touch on this a little bit more in just a minute. So the reason I chose a picture of this person here walking on this cliff is because you can see there's very defined risk. If this person gets beyond this point of no return, his or her risk goes from like 0 to like 100% instantly, like that. And it's the same exact thing with using candles. If we know exactly where we need to get out in an absolute worst scenario, or we need to take profits, you know, that's a huge benefit to have, you know, as opposed to over other things where we're learning different types of pattern names and all those kind of things that, you know, that's all well and good, but if you can't stick to those rules, it's kind of all for nothing. Okay, so let's look at a couple types of candles, and of course this is not all inclusive, but these are some very important types of candles, and we'll work on them through them with a couple of examples here in just a minute. So this is called a hammer candle, and whether we look at example 1, 2, 3, or 4 doesn't really matter. Let's just look at this one up here, and let's assume this was a stock and this was a one-day time frame. So we stick with what we laid out before in terms of the daily time frame. Again, this works in any time frame, that's not the issue, but I need to make sure I stay on some sort of uniform time frame throughout the presentation. Let's assume this was a stock, and again, this stock in this case, let's assume it dropped for the past few days, weeks, maybe past few months. Well, ultimately, the stock came into this day, so it's been trending down. It came into this day. It opened the day here, okay? But something happened intraday, and that stock dropped all the way down here. But by day's end, it had reversed all the way back up and actually marginally closed higher in this example. But it doesn't matter if the stock closed marginally higher on the day, whether it closed flat for the day, or even closed marginally lower for the day. What's important is that the stock failed to stay down here. Now, there's two ways of looking at this. You can look at this sort of the financial television way, right, which is what I call sort of the CNBC way, for the lack of a better term, and it's not to make fun of CNBC, that's just sort of the way they talk about it, the financial reporters to some extent. And they'll say something like, we're off the lows, Joe, back to you, which is true in this case, but there's zero emotion attached to that statement. Because the reality is that what the market did, it gave us a lot of emotions. So you need to embody or understand that emotions with the same amount of vigor, so to speak. So that's the sort of CNBC way of looking at it, the financial television way. The reality is what actually truly happened is that after a multi-day, week, month downtrend, the bears, which had been in charge, tried to push this market lower one more time. But guess what? They miserably failed to keep it down here because by day's end, the market had completely reversed higher, thus telling us that the bears failed to remain in charge of the sell-off. Okay, so that tells us that what really happened is the bears got exhausted. There were no more, or at least very few sellers left down here. So much so, the bulls took over the game. The bears completely lost it, and the market started to rally. Now, when you can tell on a chart visually what happened with investor emotions or investor psychology, i.e., in this case, bears exhaust themselves, the point of maximum bearishness had been reached. If you could visually determine that, think about it. Wouldn't you have an easier time taking the other side of that? Because you know that there's literally no more sellers or very few sellers left. Wouldn't you have an easier time buying a stock or at least closing your short position? Think about it. And you can answer this question out loud if you want, but you must have an easier time. It's just how it is. So if that happens, if there's no more sellers left or very few sellers left, then the path of least resistance, for the most part at least, is higher or sideways in this case for the stock. Let's look at another example. Let's look at a bearish example in this case just to kind of mix it up. Here we're looking at, let's assume again it was a stock and it was a daily time frame. And let's assume the stock had been moving higher, had been rallying for the past few days, weeks, maybe it was a few months. Well, ultimately the stock came into this day, and you can see it gapped higher on this day one more time after having been in a full-on rally for the past intermediate term trend at least. But something happened, and the stock failed to stay up here after gapping higher and quickly reversed lower, so much so that it actually meaningfully closed lower on the day, fully engulfing that previous day or maybe the previous day's price action. Now that in and of itself isn't so important. What's important is to understand is what actually took place. Now again, we can look at this sort of the financial media way, which is to say that we're off the highs, Joe, back to you. And again, there's nothing wrong with that except that there's no real emotions involved in that statement, when in reality, the market reacted very, very powerfully and very emotionally on that day. Because truthfully what happened is that the market, after having been charged, the bulls, for having been in charge for the past days, weeks, actually gapped market high one more time, but completely failed to keep the market up here and reverse the market lower. So there were no more buyers left up here, right? No more buyers left. Buyers exhausted. Basically, there were no more bears left, in so in a sense, everyone got bullish in this time frame. So when that happens and there's no more buyers left, there's really only one thing that happened. That's for the stock at the very least to go sideways, but most likely it's going to start trickling lower. Okay, so keep this in mind as we work through some of these examples. And I'm going to skip a couple slides here in the interest of time. We're going to walk through a couple of slides, examples here. What we're going to do is we're going to go through a couple of bullet points, and then each time we're going to flip over and blow up the chart to the right of it. So what we're going to look at here is the chart of the S&P 500 in just 1 second, where we had a waterfall sell-off, which was followed by exhaustion selling, a strong bullish reversal, and finally a bullish continuation buying day. Let's look at this closer. It was the middle of October 2014, and you can see for some time here the bears were in control. They were pushing this market lower until they came to about this, like I said, the middle part of October, and you can see that the bears tried their very best to push this market lower two times in a row, but failed to keep it down 2 times in a row until ultimately on the third day we have something called a follow-through buying day. So essentially what happened, and again we can look at this through just purely the lens of price action, which I do not think is enough. So if you look at this just through pure lens of price action, which is to say that okay, we're off the lows, it doesn't tell you exactly nearly the emotions that were involved on these 2 days. Because what happened is the bears had been very much in charge, but ultimately they failed to keep the market lower 2 days in a row, a third day higher in the market. Third day was a follow-through with buying day and the market raised higher. If you can visually look at this price action and understand that the bears most likely exhausted themselves here, okay, which is exactly what happened. Wouldn't you have an easier time to go in and actually buy this market once you had a follow through buying day? But if you look at just the length of price action, maybe you learn what this pattern is called. Whatever it's called, it doesn't matter what it's called. The reality is that learning these names make things too complicated. Okay? So what you need to understand is what happened through the lens of price action. You can visibly see it. The price action is actually telling us exactly what took place. And what took place is that the bears got visibly exhausted. They could no longer keep this market down here. And then they rallied it on the third day and it was off to the races. Okay? Let's look at another example. This is the KBW Bank Index, or the BKX as it's known. And what we're looking at here, this was actually about maybe a year and about a month ago, in the early part of October last year. And you can see what took place here. But again, we'll blow up this chart in just a minute. We're looking at a bottoming process followed by exhaustion selling, and ultimately a strong bearish reversal, I should say, and then a strong bullish continuation. I'm sorry, excuse me, ultimately a strong bullish reversal and a bullish continuation buying day. Doesn't matter. Let's look at the chart and you'll see more clearly. If you might recall, in August of 2015, if you guys were involved in the market at that time, who was involved in the market in 2015? or are you guys all brand new traders, which I doubt. Anyway, what happened, we had a very strong sell-off in the August of 2015. It was one of those things that caught a lot of people off guard, and then basically, so as the market went, so did the banks, and vice versa. But then the banks started to sort of bounce sideways. But then we came into one of the first couple of days of October, and someone is saying it was their first trading day, August 24th, a crash. That's probably why you're going to be successful, Giselle. So that's good. Trial by fire, exactly, really good. So what happened on about I guess one of the first couple of days trading days of October is that the bulls, or the bears, I should say, tried very hard to push this market lower one more time. In fact, they tried to push it below those August 2015 lows. You can see that. But guess what? They can miserably fail to keep the market down there. You can see that. They were just hopeless, right? They completely quickly reversed the market back higher, and the very next day the market gapped higher and it was off to the races from there. Now again, let's look at it just through the lens of price action, which is, like I said before, not all that helpful. If you look at the lens of price action, yes, we closed off the lows, and that's that. But what really truly happened is that the bears, after having been in charge for some time, tried to push this market lower once. They tried to push this market below those August low, miserably failed. There was just zero interest by any sellers down there anymore, and the market started rallying higher. If you could see that and understand that the bears got exhausted, you will have a much easier time buying a market like that, or at least closing you short. Think about that. If you can consistently start to think that way, which is actually very, very easy, guys, if you can start looking at the market that way, not only will you become much more profitable, like instantly, your trading will also become so much less hectic. You'll start putting on trades, flowing in and out of them like an absolute champ. It is a beautiful thing. I've seen so many people come through this teaching of mine, and they just literally have these aha moments, and it's such a beautiful, beautiful thing. So let's continue. Look at one more example. Look at the Spider Gold Trust, or the GLD ETF, which I'm pretty sure most of you guys, or at least a lot of you guys, are probably familiar with. So what we can look at here is basically about a topping process take place, followed by exhaustion selling, ultimately a strong bearish reversal and follow through selling. Let's just look at the charts. It's easier to just trade this as opposed to just giving you a bunch of words. Going back to my statistic from earlier. So this is the GLD ETF. And what you can see, we had our multi-month uptrend here in the GLD, and ultimately we came into this period here in the middle part of October 2015. Just one example, of course, this happens all the time, this kind of stuff. And there was actually already a bearish reversal type of stuff happening here, but much more interesting to me is when it becomes really, really, really visually obvious. The most visually obvious price action, like big long candles or failed rallies or failed sell-offs, those are the visually most obvious spots where you can detect price action where investors get either too greedy or too fearful. And those are the spots in the market that we need to start focusing on, okay? So let me show you guys what happened. So we had a multi-month rally, ultimately we had a multi-week sort of blow-off rally, and then we sort of topped off, came down a little bit, but most importantly is what happened on this day. I guess it's one of the last few trading days of October 2015, and look what happened here. I don't know if Giselle, if you saw this at the time, you seem to have been pretty fresh at the time, so maybe you caught that. we had a rally attempt by the bulls on that day, and you can see what happened. They've tried their very best intraday to push this market higher. Maybe they wanted to get it back up to those highs here. Maybe they wanted to push it back higher. But look what happened. They miserably failed. There were no more buyers left. So much so that the market completely reversed lower, fully engulfing the previous few days' price action. The next day, the very next day, a gap down, and the market was off to the races lower. Now again, looking at the lens of price action, yes, we would have seen that we had a failed intraday rally, but understand what happened. Understand what happened. There was a complete failure by the bulls who tried to push the market higher to stay it up there. We reversed lower, bearish reversal engulfing, and boom to the downside. Okay, get to understand what happens in terms of price action. Look at price action to the lens of investor psychology, or look at or vice versa. It doesn't matter. Either way, how you want to look at it. Okay, so let's just skip this example here in the interest of time. Let's move on to my three-step process. Now, very important, guys, and I haven't listened to all the presentation today, but I know most of the guys that are presenting today very well, and I know what they teach, and it's all very, very good and honorable stuff. What I think is really important, and what I always preach, which is a little bit different from other folks, I always make sure people don't have a purely technical approach. Because as much as the price action is ultimately the only thing, it is important to be able to contextualize price action, because you can misread price action very easily unless you understand what the environment is we're in. So to me, very important as a step one to the trade, and this is something I learned by working at places like JP Morgan, and ultimately starting off on my own is something that you really learn quickly. Without context, you can't become a good trader, or you can't consistently make money over the years. So you have to have an understanding at an even point where we are in the broader market structure. And what is that? By my definition, broader market structure is relating to monetary policy, economic cycle. Where are we? Early, mid, late cycle of a cyclical or secular bull market, bear market, that kind of thing. And maybe understand also where we are in terms of political environment. That usually has something to do. So that to me is the market structure. Understand where we are in that kind of stuff. Like right now, for example, if you look at the world, we have essentially a very slow, in fact, a slowing U.S. and mostly a global economy. If you look at economic data points, most things are slowing. Industrial services just a couple of weeks ago, they actually slowed 1% year over year, just as one data point. Same thing continues to happen with employment on a rate of change terms. Things are slowing, and they have been for a year and a half. And the same thing's happening with top and bottom line on the corporate side. So we're in a very late sort of cyclical bull market. I think we're in a secular bull market, but we're in a spot where really rates can't really go higher much, given where we are. Yes, the Fed may hike another quarter basis point later this year. That's entirely possible. That is more, let's call it, reputation based rather than economic reality. So we're in a spot where things are slow. So you don't want to chase things higher that are rallying unless there's a real growth story. So really, you're better off selling rallies than chasing things higher. Now, step number two is once you have that sort of context, which is really important. And again, you don't have to read the Wall Street Journal from front to back every day. In fact, I think if you do, that's probably you do yourself a disservice. But make sure you understand where we are in this big picture. And then you make sure you look for stocks or commodities where you're focusing on that work or don't work, in that type of environment. And then step three, you look for these strong bullish and bearish reversals that I just explained to you guys. Okay, so really, really, really important to understand that you can also reverse engineer this. Okay, let's say you come across some sort of strong bullish bearish reversal and you wonder if it's worth taking. Well, make sure it fits into step number two, i.e. in the series of stocks that need to work well in that environment, and then make sure step number one, that also still is the bigger picture that you had initially laid out to be in. Okay, so let's move on and look at these charts here through this step 1, 2, 3 process. So step one, let's look at the broad market structure, and what we're looking at here is the S&P 500, guys. Same chart we looked at before, but now we're looking at it on a longer term time frame. So before we looked at the S&P 500 in the mid part of October 2014, that's actually this part right here. If you would have had context as you need to have in trading and investing, you would have understood that at the time the economy was still expanding. U.S. economy. The Fed was still being accommodative. In fact, was still being dovish. And ultimately, if you would have seen where that strong bullish reversal took place on the daily chart, you would have seen that it actually in the multi-year chart took place on this long-term uptrend line. If you would have been aware what step one is, i.e. that the market is, the economy is still growing, the Fed is still accommodative, you would have had a much easier time trading and buying the S&P at that point. I had a lot of hedge funds and clients around the world calling me, I remember in that middle of October 2014 period, which is why I'm using it as an example so much. And they were all freaking out saying, oh, the 2011 market is breaking down, but bull markets are blah, 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 so on and so forth. And I say, listen, guys, number one, nothing's changed broad market structure. Number two, let's wait where this stuff closes on a weekly basis, and let's wait for confirmation buying if and when that happens. Sure enough, within a couple of days later, we had confirmation buying that also happened on the weekly chart, as you can see here, and we bought with both hands, and clients were very, very happy with that call. We also had extremely defined risk right down here. Okay, so again, the step 1, 2, 3 process, very, very important, guys. If you don't take anything else away from this process, from this presentation, guys, understand to look at stuff through the lens of investment psychology, but please make sure you have a step 1, 2, 3 step process. It's really important to understand step one is an integral part of any trading strategy. It doesn't matter, even if you're a day trader, it seriously matters. Okay, let's look at another example here before we look at the KBW Bank Index, the BKX. And by the way, if you're not using this banking index to look at, make sure you do so. The banks are very important to watch on a daily basis or a weekly basis, depending on what your time frame is. So what happened here? Again, let's walk through the step 1, 2, 3 step process. So this was the middle, or I guess the early part of October 2015. And what happened at the time is that the Fed started getting quite hawkish. In other words, they were starting to threaten this interest rate raise that they ultimately and finally actually ended up doing in December of 2015. So, December of last year, that actually took place. Well, if you would have been aware of this, step 1, then you would have seen that this strong bullish reversal also actually took place on a weekly closing basis, and guess what? It took place on a multi-year horizontal support area, right? So if you would have had this context of the step 1, 2, 3 process, you would have had a much easier time buying. You would have a much easier time buying the KBW Bank Index or the banking stocks or the financial stocks in general. Would you have had this context? And again, it was another one of those periods where I remember where banks are selling off, and I remember getting a lot of calls in around those couple days periods where the bank sell was attempting to take place. And I said, listen, guys, context. The Fed is getting dovish. Hawkish. Maybe that's one thing to watch out for the banks. Number 2, let's see what we're looking at technically. And step 3, look at this also on a daily and on a weekly basis. So step 1 through 3 process, guys, really important. And looking at this through the lens of investor psychology, there were no more sellers left down here. They were exhausted. And if you can overlay that with your step 1 through 3 process, or vice versa, you have an unbelievably great trading strategy you can apply on a repeatable basis. And thirdly, let's just quickly keep this with the lens of price action real quick. Remember that bearish reversal I showed you guys for gold earlier? Well, if you would have had context, you would have understood that bearish reversal also took place at a really important multi-year downtrend right here, and the bears got exhausted, not only on a daily basis, but also on a weekly closing basis. And that in and of itself would have given you much more context and much more confidence to sell your long position or even short the gold GLD or buy put options or whatever you'd like to do. Okay, so let's skip to this example in the interest of time. Let's move on. And I want to quickly, before we take some questions, I want to go through a whole bunch of charts with you guys. Please show me some charts you want to look at. I would love to show you guys some bullish and bearish reversals. I'm going to give you guys a couple that I'm looking at right now, for example, in Amazon.com, where I think trade is setting up. But first, let me show you guys my options trade setup. I think the absolute highest probability options trade that you'll ever come across, guys, is when you look at a cult stock, and by the way, this works in any asset. This will work for a currency, this will work for a commodity, but let's focus on cult stock because most people might know things like these, like Amazon.com and Teslas and Facebooks. When a cult stock, which is a stock that gets chased higher, has a strong rally, a strong steep rally, and when that rally that's already steep in slope, it basically takes the slope into vertical overshooting mode, which we've basically seen in Amazon.com, for example, for some time now, and we'll go through this in just a bit, but you can look at here in Tesla, for example. What tends to happen is that the implied volatility actually tends to rise. The reason why is because market makers and other smart money that look at this understand that the rate of change in the stock to the upside most likely is not sustainable at that rate. So what then happens is once you get a bearish reversal, like we just showed you, and I'm going to show you guys more in just 1 minute, what happens is that you will get the absolute highest probability trade you'll ever find in options, because you can go out and sell out of the money call spreads for great monthly income, literally 10, 20, 30 or plus % out of the money for really, really, really juicy options income, for monthly options income that you plan ahead 1, 2, 3 months into the future. If you do this and repeat this on a monthly basis, you have the highest probability options income strategy you'll ever come across. Okay. Now again, in an inch of time, I can't explain the strategy in super great detail, but this is the thing, guys. Look for stocks that have a very steep rally, like an extended steep rally for like months or weeks or even years. And when that rally goes into vertical overshooting mode, like for example, we have in a stock called NVIDIA right now, NVDA. Look at that stock. At some point, once there is a bearish reversal of significant size, you will have the highest probability in my personal opinion, of any trade out there to sell out of money call spreads for seriously juicy income, and you repeat that, you rinse and repeat that, and you see serious income coming in on a monthly basis going forward. Okay, so in summary, quickly before we look at all the questions, and I will show you guys a lot of examples. Candles show investor footprints and emotions. Okay, that's the reality. You must have a straightforward and repeatable process. That's the key to consistent profits as a trader and active investor. So my three-prong trading process, you have to understand the market structure, make sure you scan for technically sound stocks and commodities in or whatever, in the direction or against the direction of that general environment, and then you use your basic 1, 2, 3 step reversal to buy or sell at the underlying asset. Let's look at a couple examples. So someone wants to look at Nike here, for example. So Nike, I specifically remember Nike as a really interesting setup. So let's look at Nike here, and we're just using very, very basic, simple moving averages, by the way. This is nothing complex. Again, I like to keep it simple. Let's look at Nike, for example. I guess we can look at the daily chart as well. It doesn't really matter. But Nike gave us such a beautiful setup here. This was, I think, December 2015, so last December. Look what happened here. We had a very nice rally throughout 2015, and Nike ultimately started exhausting itself here and couldn't go higher anymore. You can see how the stock started to stall. Well, on this day, which again, this was the 23rd of December last year, look what happened. The bulls tried their very best to push this market higher one more time. Well, they miserably failed to keep the market up there. They quickly reversed lower, so much so that it fully engulfed the previous day's price action. The next day, the stock market gapped lower, or that shares of Nike gapped lower, and then it was lower from there. Okay. Now again, we can look at this just the lens of price action, but what really happened is that the stock exhausted itself. Okay. There were no more buyers left up here, no more buyers left. And when that happens, if you can look at that and you understand that the market there are no more buyers, so you'll have such an easy time starting to understand that the market most likely will not be able to push above here. So you could either short the stock, you can sell it if you're long, you can sell it on money call spreads, whatever you want to do. If you understand the importance of what happened that day, you will have such a better, easier time to stick to your trading time frames, to your trading plan. It's not even funny. Facebook, people want to know about Facebook. Let's look at Facebook. That is a good example. So let's look at, for example, I don't know, let's look at like right here. This was the February lows of this year. That's the 200-day moving average, by the way, guys, here in red. And these moving averages are the 50-day in yellow, then the 100-day in blue, and the 200-day in red. Well, what happened here is Facebook sold off into the early part, or I guess late part of January of this year. And then look what happened. You can visibly see that the market, or Facebook stock, failed to keep down, right? It literally on that day bounced right off to the moving average. It closed back above it after attempting to try to push below there on that day. Well, what happened is you can visibly see that the sellers exhausted themselves by the fact that they failed to keep the market lower and closed it near the upper quadrant, let's say, of that day. 2 days later, and this is the key, the market gapped higher and boom, rallied to the upside. right? So again, this is a hugely key spot to understand what happened to the lens of price action, not just technical analysis. Forget that. It's not that important. What actually is price action telling us? What happened to the investors? In this case, the bears got exhausted. Then let's go back up here. The stock market then rallied, or the Facebook stock then rallied. Tried to keep the rally going on this day, which was February the 2nd. Failed to keep higher on the day. Bulls exhausted themselves. The very next day, boom, a down day. The market closed lower on the day, and it was lower from there. If you can determine these spots in the market, then you'll understand that all this crap in the middle, for lack of a better term, excuse the language, is useless to trade. Any single given stock, in my strong opinion, will only give you meaningful and important high probability entries every few weeks, maybe even every few months, okay? Maybe if you day trade, that's a little bit different, but even there, I think that holds true. Focus on the most liquid investments out there and look for this kind of trading setups across the universe of stocks, commodities, and bonds if you want to. That, in my opinion, is the very highest probability way of using. You're very welcome, Eric. Eric is asking me what my simple moving averages, or that they're simple moving averages, yes. Okay, now what I want to offer you guys, and I'm going to go through a lot more questions for you guys in a lot of time that I have. I'm going to offer you guys my ultimate candlestick bootcamp. What this is my 11-part recorded video series that has been super sought after, and we're getting amazing feedback. You're going to learn all the great details of my institutional three-prong trading approach. Maybe you guys are a little bit confused still after what I just went through. That is normal, and it's exactly where you should be at, I think. What I'm going to show you guys in this course is exactly how to do this, okay? You're going to learn all the details. It's all about having a low-stress, high-probability swing trading method, or any time frame for that matter. You're going to learn my bullish and bearish reversals, and you're going to learn how to nail these by correctly reading investor sentiment and emotions using candlesticks and more. Now, this 11-part recorded video series comes with a 30-page detailed course guide that people love. Usually this is $247 today. I'm going to sell it to you guys for just $97. You can go to thestrategytrader.com/get, thestrategytrader.com/get. I'm going to type that in. Okay, and it's just a one-time payment. Don't worry. This is not a recurring payment, just a one-time payment of $97 for this 11-part recorded video series, which is super awesome. And I would highly encourage you guys to do that if you really want to learn how to become a high probability trader. There's a 30-day money-back guarantee. If you guys don't like it after 30 days, I don't really want you $97, but you know, I feel very comfortable that you guys will like this. Who is this course not for? I don't think this is for people who are looking to just kind of do this for entertainment. A lot of people, unfortunately, want to come in. They just want people to feed them a trade and do the trade and not think about it. Most likely, people who do that and come in for the entertainment, they will never become profitable. I've seen this too many times. So the people who this course really is for, guys, is I think you know, I think this is for people who really want to learn this truly and want to reach financial independence. This is for people who truly want to become financially independent in their trading and ultimately in their lifestyle. And so that's really the people that I want to accept that take this course and take on. I don't really want to get people involved in you know, who are just trying to gamble. What you're going to learn is my institutional three-prong trading approach. You're going to learn all the variations of the bullish, bearish reversals, how to use the candles to trade in the direction of the trend and against it. You're not going to have to learn hundreds of candlesticks patterns. You're going to learn my rocket launch, gravity pull setups as well. My probability enhancers. You're going to learn all about multi-time frame analysis, guys. I should charge thousands of bucks just for this. But you're going to learn all about multi-time frame analysis using this, and confluence zones. It's so powerful. You're also going to learn all the sideways channel breakouts, wedge and flag pattern breakouts, lateral breakouts, trading gaps, resistance support lines, moving average, and oscillators, and Fibonacci adjustments. All in there. So yes, Jell is saying that confluence zones are great. You guys, this is such an awesome course. Like I actually repeatedly watch what I did, and just kind of as a good reminder. So go to thestrategytrader.com, thestrategytrader.com/get. It's just $97. You're also going to learn where to set your stops. You can learn a sound risk management strategy, the mental aspect of trading, money management. It's just jam-packed. There's just so much stuff in here. I think you guys are absolutely love this. And I am told to wrap up. I'll just go through one more quick example, and then we're going to wrap this. But I know some people you guys are asking for a lot of questions here. That's really good. Someone wanted to look at. Let's see. Yeah. So someone wanted to look at this stock here. This is a stock called. stock called IMAX. Person wants to go through. Let's quickly look at this. See if there's a strong bullish reversal. Yeah, so like for example here, look at the strong bullish reversal. If you would have understood what happened down here, right? Look at this. The bears visibly got very, very exhausted, right? Closed well off today's low. Next day, bullish engulfing, boom, off to the races higher, right? Again, look at the price action, guys, through the lens of investor psychology, and I promise you, your P&L curve is going to change overnight. Your mindset is going to make you so much more at ease in terms of trading. As you're going to stop looking at this as something that's nervous. You are going to look at this and you understand that the bears in this case were completely exhausted, and you know, that in and of itself will help you stick to your trading plan. You can become much more profitable very quickly. All right, guys. Hope to join you guys. I hope you guys will join me. I'm sorry. Again, it's thestrategytrader.com/get. It's just $97, one-time payment, 11-part recorded video series, and a 30-page ebook. And with that, I want to thank the organizer of the webinar. Thank you so much, Renee. Thank you guys for listening. Have a wonderful, great rest of the weekend. Thank you, Giselle and everyone. It was a great pleasure to be here. Thank you, Eric. Thank you, guys. And I'll tune it back to the organizers. Thank you so much, guys.